Okay, buying a home. You've got four main loan types to know. Let's break them down, quick.
So, FHA, VA, USDA, conventional. What's really the difference? Let's put them head to head. It's easiest to think of them in two big families, government-backed and, conventional.
You're seeing that right. A big fat zero. That's the down payment for VA and USDA loans.
Then you have FHA loans. Their minimum down payment is just 3.5%.
So here's how it all stacks up. The cash you need up front really depends on the loan you get. But with the low down payment, how does the lender protect themselves? Well, that's where insurance comes in. Now, not all insurance is the same. Conventional has PMI, while FHA has what's called MIP.
And here's the real kicker. You can actually get rid of PMI. MIP? Yeah, not so easy.
What about VA and USDA? They have a totally different system, a one-time fee, no monthly insurance. Okay, so besides money, there are special rules. Not just anyone can get every type of loan. For VA loans, it's all about service, and you have to prove it with a certificate of eligibility.
And USDA loans, they're super specific. It's all about your income and the property's location.
And don't get tripped up by the word rural. It doesn't just mean farms. Think suburbs, too. So how does a lender see all this? They measure risk with one number, loan-to-value, or LTV. And here's the golden rule for value. The lender always uses the lower of the two numbers. See, a high LTV means more risk, which is why the lender requires that insurance. It all connects. All right, let's wrap this up by busting some of the most common myths out there.
First, the FHA isn't a lender, it's an insurer. And it's for everyone, not just first-timers.
And for VA loans, that zero down isn't a guarantee. It really depends on that appraisal.
So which loan is the best? Well, there's no single answer. It all comes down to the buyer.